Are you a business owner and do you feel as though the banks aren't helping you with your financing goals? Well, Erin and I today are going to talk about some different financing options in the market that are going to allow you to purchase either a home or rental property as a business owner.
We're going to take a look at your business for self mortgage strategies on the A side with our B lenders and some of our private lenders that include no doc type income, so stay tuned. Hey guys, Aaron and Josh with the Findlay Mortgage Team, and today we want to take a look at some of the options that we have for business for self individuals.
Are you a self-employed individual and do you find that sometimes the banks will penalize you for owning your own business? You're not alone. The reality is that most banks look at something called verifiable income, and one of the advantages of being a business owner or owning your own business is the fact that you can choose how much you make on paper, which means how much verifiable income you have. Now the challenge with this is that most people from a tax advantage perspective claim less on their income but keep more in their corporation to allow them to not pay as much taxes. And this isn't some sort of like scheme or some sort of thing that's hidden from the CRA. You're allowed to do this because there's tax that's based in your corporation and there's tax based in your personal income. Now the government's going to take it either way. It's just there's two different types of taxes and different marginal tax rates that you have for how you decide to split your income. The challenge with this is the banks will only give you a mortgage based off of your verifiable income.
Yeah, when we're taking a look at business for self owners, we're taking a look at either the T4 income that you're going to pay yourself, or if you're pulling out a dividend, we're using a 2-year average of either of those two, but it's got to be shown on your T1 tax returns. That's what we're taking a look at. Now, if you're someone who writes that income down, like we just mentioned, something I see a lot, especially a lot of IT guys, we're seeing $250,000, $300,000, and on the taxes we're seeing $35,000 to $50,000. Obviously, there's a lot more income there that we can tap into. So our best option and our most common solution is taking a look at the B side, and we're using our bank statement program. The bank statement program allows us to take a look at your business bank statements from either your last 3 months, 6 months, or 12 months, annualizing those statements out, taking a look at your reasonable shown business expenses, and then we're allowed to qualify with that net difference. And we're going this route, especially some of these IT type consulting businesses where you have really no overhead expenses. Your gross profit margins when we're using this product is quite high. We're seeing anywhere from like 80 to 95% of that gross profit margin being able to use to help you guys qualify in your next transaction.
Now, when you're looking at this type of financing, it's important to understand that these are non-insured mortgage products. For someone who doesn't know what that is, that essentially means that you won't have any CMHC or SEG in insurance, which means you can't put less than 5% down or 20% down on a purchase. This is actually decently significant because most borrowers who are looking to buy their first home, they have this idea that they can put 5% down, but if you don't have the verifiable income to prove it, you can't actually use this type of product to purchase your first home.
Now, when we're working with these B lenders, there are a couple extra types of approvable down payment sources that we can use. We're still able to use our home equity lines of credits, but the B lenders also allow you to borrow from your revolving debt. So your personal lines of credits, and if you really wanted to, you could pull from your credit cards as well too. Now, just keep in mind, if you are going this route, you do have to be able to debt service that additional payment that you would incur by pulling out this debt, but that is an option on the B side if you're looking for some help with your down payment.
Yeah, now that being said, there are also some A solutions for self-employed people as well. So most people know that some of the wealthiest people in our country are self-employed. And obviously, as we said before, there are some tax advantages of not paying yourself on a T1 or T5. Now, if you have a large net worth, depending on the lender, it could be between $150,000 to $500,000 in liquid verifiable assets. You can actually use these verifiable assets to allow you to qualify for a mortgage. So some of the big 5 banks allow you to be able to have up to 60% TDS. That'll allow you to have 80% loan to value in your purchase, or if you're over 60% TDS, they'll actually drop your loan to value, but you can still qualify with your verifiable income. So if you are very cash heavy, there are some conventional ways that you could qualify for a mortgage without necessarily needing to go on to alternative financing.
Now, when we're looking at business for self-owners, one of the things that we got to keep in mind is how long have you been in business for? When we're looking at our A lenders, they want you to at least have that 2-year average of income. So, obviously you have to be in business for at least 2 years, or at least long enough that you have 2 tax seasons worth of documents. When we're taking a look at our B lenders and some of our subprime private lenders, that time in business can be reduced drastically. So, we have B lenders that will allow you to do a stated income product if you've only been in business for 6 months. So, that's a really short time period. That's going to be helpful for a lot of people that are just getting into business. Some of the private lenders that we work with as well too, again, not necessarily maybe a minimum time frame, especially if you have experience in previous industries that are similar to yours. So if you're now a consultant but you had 10 years of experience in that same field as an employee, there are some lenders that will allow you to use kind of like a next day if you have your business license, and we can draw on that experience. So there are a lot of different products out there given the circumstances of the borrower, and that's something that we'd have to determine during our initial consultation. When we sit down, we take a look at who you are, what are the things that we have to work with to be able to plan out your financing, and then that's going to determine which lender and product that we're going to have to move forward with.
I completely agree. The options that are in the market, there are a handful of different lenders that operate like this. So there are some lenders who will use your specific industry and then how much gross deposits you have in your actual business over a 12-month period, and they'll just use a peg benchmark percentage of your total gross income. And there's some, as Ehren said, that will take a look at all 12 months of bank statements. They'll deduct from reasonable expenses and use that gross or net too, depending on what exactly you have. Now, there are 2 very advantageous ways of looking at things, and that's going to be for us to determine what's the best lender and solution for you depending on what your bank statements look like. There are a handful of challenges with purchasing real estate as a business owner, but understand that as you transition into that alternative financing options, there are some more creative ways that you can purchase real estate. And one of the advantages to purchasing real estate with those creative options is the rental offsetting that you have. So if you are a business owner and you have additional properties in your portfolio already and they're cash flowing and they're debt servicing, we can use those to actually help you qualify for your next property as well. So there isn't always a downside to it. Now you may wonder, what is the downside to purchasing with this alternative financing option? One being it is a little more expensive. For an owner-occupied property, you're about 50 basis points to 65 basis points more than what the conventional lenders are at the moment. They do have increased amortization options, so because the rate is increased slightly, that increased amortization option might actually make it decently on par with where the conventional options are at the moment. One of the downsides of this type of financing is that the most competitive rate on the market is usually a 1-year term. That 1-year term kind of gives you a short period of time. It doesn't allow you to be able to kind of lock it in and project out over 5 years. Now there are longer term options available in the market, but they're at a premium. So just keep in mind that you are kind of at the mercy of the market in 12 months from now if you take a 1-year term, because we don't know where rates are going to be at that time.
One other thing to keep in mind with these alternative lenders is your cost for a transaction. So on our B lenders, you are looking at a 2% of the loan amount cost per transaction. So when we're taking a look at business owners, at the start of the year when you're doing your taxes, or I guess at the end of the year, you got to sit down and kind of plan your year out. How many properties are you going to buy? What are your fees going to look like? And does it make more sense for you to pay your taxes and show your provable income to be able to qualify on the A side? Or does it make more sense for you to save on some of the taxes, show less, and pay some of the fees on the B side? And really just comes down to how many transactions are you going to be doing? If you're taking a look at 2% versus maybe, let's say, 40, 50 grand a year in taxes, well, are you going to do enough transactions that you're going to pay $60,000 in fees, $70,000 in fees, or are you looking at real estate that's higher price? So that's something that you should sit down with your accountant at the beginning of the year, maybe talk to your mortgage broker as well too, and try to figure that out. But just as a reminder, there are some additional fees on the B side to consider.
Yeah, that's a great thing to think about when you are projecting out your goals for next year and exactly how much real estate you're going to be buying. Lastly, there are some other additional options outside of that alternative option. So there are some mortgage investment corporations, and I know we've discussed this previously about the different levels of capital and the options that are available in the market. So these options also allow for amortized debt. Currently, right now, there's some very aggressive mix in the market. We're looking at 7.5% private money with a 40-year or 50-year AM. This allows you to be able to get in with either no documentation or very little documentation if you are a business owner, maybe just starting, or you've had a slow year during during COVID or whatever that might look like, there are some other options to allow you to have amortized debt with less conventional banks.
As we've seen in 2022, obviously the strange market really dictates how you're moving forwards, and really means you need to have a lot more due diligence on your strategies and transactions. If you're looking to take advantage of this program, make sure you sit down with your accountant and with your mortgage broker. Make sure you get both pieces of information and you put together the right options moving forward for long-term strategies. If you are taking advantage of the B-side product, just keep in mind, if you want to transition back to an A-side product, there are 2 consecutive years of taxes that you have to be able to show before you can start qualifying with that higher income on the A side. So you are going to have that 2-year period of making those changes.
Yeah, we really appreciate everybody watching today. Ehren and I work really hard on creating some great content for you. So if you really like this video today, please hit the subscribe button, hit the like button. It would allow us to create more content for you like this. Really appreciate it, guys. If you have any questions, reach out to both of us. Again, hit that like button. We'll see you next time.